SoFi is set to report earnings on November 10th, giving us the best opportunity to see a rapid stock price rise and to potentially hit a new all-time high that we've had in recent months. There are several catalysts which could propel SoFi's stock sky high, the same way we saw other fintech companies such as Lending Club and Upstart double or even quadruple in just a few months after reporting blowout earnings. So in this video, I'm going to be focusing on 3 catalysts for SoFi's stock and what we might learn about them during their upcoming earnings call. Those are going to be SoFi's growth of their business segments, including the potential impacts that their SoFi Stadium is having, their overall revenue growth, and the potential approval of their bank charter, an event that's been generating a ton of hype recently. So hit the like button if you want, and let's start by talking about what kind of growth we might see from SoFi in their Q3 earnings call. We know that SoFi is really 3 businesses in one at this point. Those are financial services, technology platform, and lending. And between these 3 businesses, SoFi hopes to build a fintech ecosystem where they can attract customers for very low customer acquisition costs using their SoFi mobile app services like SoFi Money and SoFi Invest, and then funnel those users into more profitable areas of the company like lending. Financial services is one of the big growth engines for the company. It includes SoFi Money, their bank account, SoFi Invest, their investing app, and the SoFi credit card, as well as several other products. This is sort of SoFi's top of sales funnel that has relatively low margin, but is also growing by far the fastest. In the last year, this part of the business grew 7 times, with a 2.6 times increase in just the last 3 months. Their technology platform, also called Galileo, is a payments processor mixed with a somewhat independently operating company, one that SoFi shelled out $1.2 billion for in 2020 as an acquisition, which leaves their lending platform, the original bread and butter of the company and by far their most profitable area. This is where SoFi currently has the least growth, but also drives most of the company's profit. Each of these areas of business contributes to SoFi's overall plan to become the winner in what they see as a winner takes most market. Now, when SoFi said that, they were talking about the fintech market, but SoFi is also starting to see a rebound after the general SPAC-induced drop in its price a few months back. And famous investor Chamath commented on it.
2/3 of SPACs that went public this year are trading below their offer price. Was it all a bubble?
No, but I do think that in the beginning of every market, you have a few people that pioneer something, and then you have a lot of fast followers. And I think it's always important to take a step back when you have all that fast following to sort it out. And I think we're in the midst of sorting that out and separating the wheat from the chaff.
With SoFi's price beginning to take off and several catalysts in their near future, this earnings call could give us a direct look at how likely SoFi is to truly distinguish itself from the pack and become a true powerhouse of a company. So let's take a look at the numbers we will want to see from SoFi's earnings to make sure that vision is on track. The core of SoFi's growth is going to come down to its number of members, which has actually accelerated for the last 8 straight quarters. They have essentially quadrupled in size over the past 2 years, and in their most recent quarter, they hit 113% growth year over year. Based on this consistent acceleration, I'm guessing that the market expects continued acceleration next quarter. After all, SoFi is spending aggressively on marketing, as demonstrated by their SoFi branded stadium, which the company will pay a total of $625 million for over the course of their contract. Now, I personally don't think the stadium specifically will have a huge impact on their number of members, and you can see the data that I back that up with in my previous video. But this will also be the first quarter where we see if there was any effect from the NFL stadium, because this is the first quarter that actually overlaps with the NFL season. And more data is always a good thing. But for the metric of number of members, I would say anything less than 113% growth year over year here would be a disappointment. Looking at SoFi's number of products, this is always going to be higher than its number of members since some members use multiple products. We see a similar accelerating growth trend here. Hopefully we again see further acceleration in products, both from new members joining and from existing members using more and more products as they buy into the SoFi ecosystem. But turning our attention specifically to SoFi's financial services segment, which includes their mobile app services, they have been growing incredibly fast up to this point. And we'll expect to see another quarter of over 200% year over year growth, because again, again, this area should benefit from SoFi's overall marketing spend, and we shouldn't see a huge drop in growth rates. For SoFi's Galileo accounts, we saw a slowdown in growth last quarter, possibly simply due to hitting too large of a scale to keep on accelerating. They now have 79 million accounts on Galileo, which is equal to around 1/4 of the entire US adult population. So the company can't really double its number of accounts too many more times. Hopefully we can see this metric continue to grow above 100% year over year, but it might drop back to the low 100s for the first time this quarter. But as important as these high growth drivers are going to be, even more importantly than these two areas, we're going to want to see lending continue to grow. A big point of the sales funnel of financial services is to drive customers to SoFi's high margin lending products. And so because we've seen accelerating growth in their other areas of business, we are also going to want to see lending start to see some acceleration as well as those customers move down the funnel. But if that doesn't happen this quarter, I don't think it's the end of the world. We just want to see that happen eventually, and the sooner the better. But all of these metrics together really build toward one thing. How much money is SoFi actually making? Which is why I think the most important metric of all is revenue growth. Now I know that SoFi showed 74% year over year revenue growth last quarter, but I highly doubt we'll see growth like that again this quarter. Why? Well, just look at what the company's revenue looked like a year ago. In 2020, they saw a massive acceleration in revenue each quarter, with the biggest jump happening between Q2 2020 and Q3 2020. So even though they grew revenue 74% last quarter, compared to Q2 last year, this quarter they're going to be comparing to the crazy high revenue that they saw in Q3 2020, making any year-over-year comparison growth look a lot smaller. We actually saw something similar 3 months ago, with SoFi's year-over-year growth comparison dropping from 151% in Q1 to 74% in Q2. Again, just due to harder comparable quarters with the fast growth acceleration that they saw in 2020. SoFi forecasts their net revenue for the full year to put them up 58% year over year. So to hit that number, they would need to be well below the 58% growth in their next 2 quarters to make up for the faster growth that they had earlier in the year. They also said on their last earnings call that they expected revenue between $245 and $255 million this quarter, representing growth of around 12 to 18% year over year. That would be a massive deceleration in growth. But I do think that is a conservative estimate, and they'll probably beat the high end of that range, at least by a little. I'm basing that prediction on other fintech companies like Upstart, consistently beating their own earnings estimates. Unfortunately, we don't have that much data to compare to in SoFi's recent earnings. After all, this is only the company's second ever earnings call as a fully public company, though they did issue 2 quarters of earnings before they were public. So it's just a little hard to say if leadership is lowballing their growth forecast in this case, like a lot of other growth stocks do, or if they're actually trying to predict it accurately. One easy way we can simplify things is to annualize SoFi's quarter over quarter growth rate. So for example, if SoFi actually reports revenue of $250 million next quarter, that would represent quarter over quarter growth rate of around 5.5%. If they were to do that again for 4 straight quarters, it would equate to annual growth of around 24%. Decent, but certainly not a hyper growth stock at that point. So again, let's hope the company is lowballing and that they bring in significantly more than the $250 million that they forecast. But the last major catalyst we could see on SoFi's earnings call is the announcement of approval of their bank charter. SoFi has long talked about how it sees its biggest opportunity not in outcompeting other fintechs, but in taking away business from legacy banks. They called out how there are 500 million accounts across 4,700 FDIC banks that are up for grabs by a company that can serve the customer better by actually giving them a one-stop shop with modern technology directly integrated. Imagine not having to wait 3 to 5 business days to transfer money to your bank, or being able to see your mortgage, your savings, and your Bitcoin holdings all in the same place. Well, in order to best serve their customers, this will require SoFi to become an actual bank, rather than just partnering with banks. Most fintechs right now that offer bank-like services, so something like Robinhood's cash management account, do so by partnering with an FDIC bank. This makes it easy to get going quickly on offering financial services, but it really limits your autonomy and increases the costs of pretty much anything that you do. This can be seen super clearly in this chart that SoFi released showing the theoretical impact of a bank charter on the business. And as you can see, it is substantial. Just imagine if SoFi could act as the sponsor bank for their Galileo Technology Platform to offer virtual credit cards, kind of like Apple's partnership with Goldman Sachs, only SoFi SoFi could keep all of the fees associated with partnering with the bank and move much faster by keeping everything internal. In fact, looking at Lending Club, another fintech which actually obtained their bank charter back in February 2021, we can see an example of how powerful acquiring Radius Bank has been for their company. Lending Club saw a 90% reduction in their costs of deposits, and their CEO noted during a call with CNBC that they are driving around 30% more revenue on the same loan volume now that they have a bank charter.
Last quarter was only our second quarter as a digital bank, and you can see the results versus our prior model. We're driving about 30% more revenue on the same level of loan volume and about $27 million more in profit.
And this helped the company report incredible results last quarter, boosting the stock around 50% basically overnight. But at the same time, this was also 2 quarters after obtaining their bank charter. So while the effects took place very quickly in the business, it really took around 6 months for its stock price to accurately reflect the new value of the company. And we may see the same opportunity with SoFi. Now, SoFi's own bank charter is still pending. SoFi is in the process of acquiring a small regional bank to complete their change of control loan application. There are some minor risks there from a legal filing attempting to block that merger from going through, but SoFi did predict that the acquisition would close before the end of 2021. So on this earnings call, we could hear 2 things. One, we could hear an updated timeline for the acquisition to close, maybe a more specific date in 2021, or, and this is pretty unlikely in my opinion, we could see a delay in the acquisition, whether due to the lawsuit or some other unforeseen risk. Or option 2, we could hear an announcement that SoFi has closed on the acquisition. Now, in my personal opinion, I do not think SoFi will announce them closing on the bank charter in this earnings report. Lending Club announced their closing 2 months after their Q3 2020 earnings and 1 month before their Q4 2020 earnings. Basically, they told investors as soon as they had news, and I'm guessing SoFi would follow a similar pattern. So for this earnings call, when it comes to the bank charter, I think that no news is good news. But in addition to those catalysts, we'll also want to be on the lookout for some risks to the company that could pop up. We already mentioned the lawsuit, but that's short term. The 2 largest risks that I see for SoFi in the long term are credit risk and competition. Credit risk from fluctuating interest rates is always going to be an issue for a loan company like SoFi that keeps a lot of debt on their books. Right now, it doesn't look like that is a problem, so I don't think we're going to hear too much about it on their earnings call. But if SoFi sees potential risks from their loans in the future, it could potentially affect their forecast for future revenue growth, especially given how much longer their loans are when compared to a company like Lending Club. As far as competition, we're obviously starting to see things heat up in the fintech space. We have the old challengers like Square who are still expanding and gaining market share, but we also have new entrants like Affirm, Lending Club, and Upstart, which are starting to blow up, all of which do compete with SoFi's market. And yet, I'm not super concerned about this. Eventually, SoFi will have to compete with these other companies, sure. But for the foreseeable future, SoFi can just continue winning over dissatisfied legacy bank customers, which has really been their strategy all along. Remember, there are still 500 million accounts across 4,700 FDIC banks that are up for grabs, and SoFi's 2.5 million members are just a drop in the bucket compared to that opportunity. So what am I doing in SoFi? Well, I added around 89 shares of SoFi this past week to bring my position up to around 4 times what it was before. That was based in large part on Lending Club's incredible performance after obtaining their bank charter, and I think that even after SoFi's 40% rise this month, I still don't think the full effect of the bank charter is baked into the price quite yet. But let me know what you expect from SoFi's upcoming earnings. Don't forget to like and subscribe, and I'll see you next time.